Hello everyone, welcome to this video recording where we will be doing a scenario analysis of the level 2 and full-time intake 1 test 1 scenario. So the purpose of this video is to assist students with breaking down scenarios and making the most of their 30 minutes reading time. So let's get into it. Tech Holdings Limited, Tech, is a technology entity listed on the Zimbabwe Stock Exchange. Tech offers a wide range of products that include cloud-based e-commerce solutions, point-of-sale platforms, marketing, and order management. Tech's growth strategy is through mergers and acquisitions with other entities within the information technology industry. Tech Group has a 31 December financial year end. So in that first paragraph, the most important thing is Tech has a 31 December financial year end. Tech's customer base is international. Therefore, in order for Tech to have an international outreach, Tech developed a website in-house to advertise its services. The website has a listing of all its products and allows a customer to have a free tour of each product before they decide to order. So immediately, the keyword there is they have developed an in-house website to advertise their services. So what do we immediately think of? IAS 38, because it's intangible. Remember, also they say it's internally generated. So we know there are paragraphs in IAS 38 that specifically speak to internally generated assets. Another standard we need to think of is SIC 32. Specifically addresses websites, when to capitalize them and when to expense the cost. Moving on. The website keeps a database of the product visits, most requested, product tours, as well as the prospective customer profiles. Follow-up advertising campaigns are then made on the customers based on their profile needs. This has been a very useful tool for tech and management. Believes that it has contributed largely to its 70% client base increase in the past 2 years. So from this, they're saying the website has contributed largely to 70% client base increase in the past 2 years. So here is always a trick. Does this indicate economic benefits? So management has just, based on their opinion, said that their website has contributed to 70% increase in their client database. Would we say this proves that this website has generated economic benefits? There could be several factors that have resulted in the increase in customers and revenue. So therefore, we can't conclude that this is what generates economic benefits. The CEO of Tech in his 2018 annual report described the website as the money-making machine. The total cost incurred to put up the website was 50,000. Remember, this is the total cost. From 1 January 2018 to 30 June 2018. Okay, when it became ready and available for use. So we're saying 50,000 was incurred from 1 January 2018 to 30 June 2018. So now we need to know that according to IAS 38, we need to classify our costs into research and development. Remember, if we say they're research costs, we're going to expense them. If they're development costs, we would capitalize them. However, for us to capitalize them, we need to make reference to para 56, which gives us the 6 requirements for capitalizing costs. Some of them include technical feasibility, management's intention to use the website, can the cost be measured reliably, and economic benefits. So it says, Tech further pays 10,000 for the website maintenance costs, covering a 12-month period from 1 July 2018. We need to ask ourselves, are these maintenance costs going to be expensed or capitalized? Will we derive economic benefits from these costs, or are they just expenditure in the ordinary course of our activities? It says the accountant expensed the 10,000 but is not sure of how to account for these development costs, thus has not recorded these in the financial statements. Not recorded. So now we need to start thinking of IAS 8. Changes in policies, estimates, and errors. Remember, here we are most likely to process the actual journal as it hasn't been recorded. So we don't really have anything to correct. Moving on. Blockchain 2020. On 1 January 2016, Tech started working on a design of a new blockchain accounting software, Blockchain 2020. The software will allow the posting of a transaction to be done in the accounting records at the point of sale through blockchain technology. A survey on the appetite from the market on the software was done in 2016, and the results showed an overwhelming interest by market participants. Again, does this prove that there's future economic benefits? All costs incurred in respect of the blockchain software up to 31 December were expensed. So, costs up to 31 December were expensed. Remember, there's a part in IAS 38 that says if we already expensed but should have been capitalized, we can't reverse this. That's another paragraph we need to be aware of. So going on, we're given customer appetite survey 7,000. Just from a general analysis, this is most likely to be a research cost. Write that again, research cost. Attendance of a blockchain international convention in China. Again, this is most likely to be a research cost. Professional fees, hired IT experts, 26,000. Can we capitalize that? Or should we have capitalized that? We're not sure. So it could be research or development. Concept design and prototype software. Again, could be research or development. Business plan is probably a research cost. So, moving on. On 2 January, Tech presented to the board of directors the business plan, concept design, and prototype software. Their business plan reflected that there are no other players within the Southern African region, and target customer base was reaching 15,000 corporates. So this here is definitely the market. It is expected that this technology will be replaced by machine learning and artificial intelligence by 2025. Remember what year we're in. We're doing the 2018 financial year. So between 2018 and 2025, we can expect to earn economic benefits. So we know also that this asset will be amortized through to 2025, most likely. At the end of the meeting, the board approved the project as well as the financial proposals and the business plan. So we need to see that. We're most likely to get a discussion on intangible assets and how we treat this asset. So from what we've noted, just from the scenario, it is likely that on 2nd of January, this is when the development phase started. So from 2 January 2017 to 30 June 2017, Tech incurred the following expenditure related to the blockchain project. Final design software, 30,000. Writing of logical algorithms, 6,000. Acquisition of rights to link the software to payment systems, 4,000. Registration of software on download platforms, some 2,000. Training of product consultants, 5,000. So again, we need to split these costs into research and development. The software was available. Oh, sorry. This amount is payable per 12 months. So this amount here, 2,000, is not once off. It's paid annually. So then, are we going to recognize it as research or development? Continuing on. The software was ready and available for sale on 1 July 2017. Date we start to amortize. And said the only journal entries processed by the accountant are: he credited retained earnings with 80,000, credited bank with 47,000, and debited the blockchain with 127,000. And its journal narration is capitalization of blockchain costs. So now remember, we said that we're only going to capitalize costs incurred in the development phase. So immediately we can see that he capitalized costs that related to the research phase. So this might need to be adjusted under IAS 8 as a correction of an error. So normally in IAS 8, you're either going to be asked journals or to prepare a note. So, continuing on, they recognized debited goodwill and credited retained earnings. So, again, going to the notes here. The retained earnings of 80,000 is capitalization of project costs incurred in 2016. And the retained earnings of 50,000 in 2017 is: the accountant is adamant that the introduction of blockchain has placed them as a market leader in the information technology industry. Thus, he believes is evidenced by the sudden increase in the market capitalization in the first 6 months of the introduction of the software. The valuation of goodwill was done by an independent professional valuer. So remember, there's something about goodwill in IAS 38 that speaks to internally generated goodwill. And then moving on to note number 2. On 1 January 2016, when the development of the blockchain software started, Tech realized that it was impossible for the software development team to work with the administrative team in the same office. As a result, Tech decided to lease another office. Keyword there, lease. Immediately, I know student will be starting to think of IFRS 16. So, another office which was specifically house project development staff only. On 1 July 2016, Tech entered into a lease agreement with Shelter Limited to rent business office block number 3 at Belgravia Park. That confirms, indeed, we have IFRS 16 matter possibly. The terms of the lease agreement were as follows. Lease period is 4 years. Lease payments are 500 per month. So if we say times 12, we get 6,000 per annum. So it says, tenant will be allowed to use the office block stipulated in the contract during the lease period in any way they want, except for the operation of a nightclub or pub. The tenant may brand the block the corporate colors, and it says the lease has been correctly accounted for in the financial records. So here we won't be expected to prepare any journal entries, especially correcting ones. Now, going back to this, it says they may use the office block in any way except for. So there's an issue of, do they have control? If the answer is, the answer could be yes or no or maybe. We can't immediately say yes because they're allowed to do whatever that they want, with the exception of a certain thing. And we can't say no because they have certain rights to the building. So we would go the maybe route. Now we need to determine why we're saying maybe. Because there's a clause in their contract. It says they can use the building in any way they want except for the operations of a nightclub or a pub. Now we need to determine, does this clause deny them control or only restricts their control in a certain way? So this would be what we call a protective right, saying you're allowed to do whatever with this building with the exception of one clause. So is there control? We would say yes. However, we need to document and discuss the protective right. Moving on to note 3. The investment in Takura. On 2 January 2017, TEC acquired a 30% investment in Takura. So they acquired 30%. Immediately we start to think of an associate between 20% and 50%. When the retained earnings of Takura were 2,300,000. So this is helping us with the at acquisition journal entry. It says the purpose of this investment was to strike a business relationship with the other shareholder of Takura, LG, which would be mutually beneficial to both parties through the operations of Takura. Takura mainly specializes in information technology, research across different countries, and sells the results to various interested parties, including the government. TEC believes the future changes that technology is bringing will affect its business significantly. Therefore, by investing into a technology research company, it will have insight of potential changes and plan accordingly. TEC directors were particularly worried about the nature of research that would be conducted by Takura, as only specific research would benefit TEC. A conclusion was therefore reached that the investment would only make sense if they were able to make decisions on policies that relate to the scope of research conducted by Takura. So, going back to the initial paragraph, they struck a business relationship with another shareholder, LG. What do we start to think of? A joint arrangement. That's what we need to think of. That's under IFRS 11. Remember, they don't hold control because they don't have the 50%. However, they can still have joint control through a possible relationship with LG. So, below is an extract of the contractual arrangement between LG and TEC. Percentage stake sold by LG to TEC is 30%. Consideration is for an amount of 600,000 and a transfer of TEC's Mutare building to LG. The building had a carrying amount of 45,000 and a fair value of 48,000. Remember, when we do business combinations, we talk of remeasuring our assets and taking them at fair value. So we'd use the 48,000 for the building. TEC is to offer its expertise in various projects and facilitate the selling of research done at no cost to Takura. TEC is to extend a loan of 100,000 to LG and another loan of 50,000 to Takura. These are all intercompany transactions. Are they upstream or are they downstream? TEC is the parent, so they made a loan of 100,000 to LG. LG is not a subsidiary, it's a related party. That's covered under IAS 24. And then another loan of 50,000 to Takura. This is now specifically what we're looking for. Intercompany transactions. So, in our consolidations or in our pro forma journals, there will be effects. And then, all decisions relating to research areas and financing of the research project are made by the board of directors. So, who directs the activities? The board of directors. LG and TEC point equal representation. Equal. We're saying 50-50. So therefore, they have a 30% shareholding, but in terms of directing the relevant activity, they have a 50-50 vote. So it's clear from this that no one has control individually. However, for any decision to be made, they have to vote together, and they have established a mutually beneficial relationship to both parties. So therefore, we need to discuss joint arrangements. Once we've done that, we need to split it into a joint venture or joint operation. So our discussion is leaning less to associates and more to joint ventures and operations. And says all research findings belong to Takura. Algae and Tech have a right of first refusal to the purchase of research. If they exercise their right, they will purchase the research at prevailing market value. This just goes to say that any transactions between Edge and Tech relating to research, Algae and Tech, are done at market value for the purchase of the actual software. Continuing on, it says the following are the separate trial balances of both Tech and Takura. So Tech is the parent, Takura is the subsidiary. So remember, we're told that initially the retained earnings were 2,300,000. They've gone up to 2,600,000. So we know that there's been a movement in 300k. We're going to need to include 30% of that in Tech's profits. So we have the loan payable to Tech is denominated here. We have deferred tax, question mark. We're going to need to find the deferred tax for Tech. We're given non-current liabilities, goodwill, intangible assets. Investment in Takura has been measured at 600,000. We have other assets as well. So in terms of calculating our subsidiaries' profit, we're given revenue, we're given cost of sales, operating expenses, other income, interest income, finance costs. These finance costs are in relation to the 50,000 loan awarded to Takura by Tech. So intercompany performance. And dividend income from Takura and Takura's tax expense. So now we know when we do the group books, we'll say total revenue 700 plus 420, cost of sales 326 plus that, operating 77 plus that. Other income, we take that full amount. Interest income, we can take the 8,000. These finance costs are intercompany, so we'll need to adjust for them. Dividends from Takura, it's again another intercompany, we need to adjust for it. Continuing on, note 4. The accountant of Tech is in the process of finalizing Tech's financial statements. He has contracted you to do the tax expense note for Tech as he struggles with that area. He has provided you with the following additional information. So, it's additional information. In November 2018, the new minister, Honorable Thuli Ncube, announced the IMT tax of 2% effective from 1 November 2018. He also announced an increase in the corporate income tax rate from 25.75% to 28%. However, this would only be effective from 1 January 2019. So now we know there is a change in rate. So what's the impact of this? Remember, our current tax will use this year's current rate. Deferred tax becomes difficult. However, what we need to know is current tax, we're going to keep it at 25.75. Deferred tax, because it's going to be payable in the future, we will use 28%. The tax expense recorded in the 2017 financial statements was 42,000. This equated to the amounts paid on the fourth quarterly payment. On 15 November 2018, TEC receives the ZIMRA assessment, which reflected an assessed tax expense position of 40,000. So now remember, we have a possible. So now we know that there's an overprovision. Accountant calculated tax expense at 42,000. However, our assessed tax report was at 40,000. So there's a 2,000 overprovision. Now it says operating expenses included penalties for charges by the EMA of 6,000. Remember, penalties, you just ascertain are they deductible for tax purposes. Entertainment expense of 4,000. Remember, entertainment is a prohibited deduction. Donations to a private school sports day of $500. Are these kinds of donations deductible? Remember, our income tax legislation does mention something about deductible donations. However, these ones are not, because they're not to an association approved by the ministry. Our revenue also includes 47,000 in license fees received from a South African company. Zimbabwe and South Africa have signed a double deduction agreement whereby income generated in South Africa by Zimbabweans are only taxed in South Africa. The corporate income tax rate in South Africa is 28%. So this amount is another permanent difference because it will never be taxed in Zimbabwe. So this is another permanent difference. Entertainment expense is another permanent difference. And the charge by EMA is a permanent difference. So there we go. We have all our permanent differences. And going on to the last part, the taxable temporary difference balances through profit and loss were 65,000 in 2017 and 95,000 in 2018. These balances were correctly calculated, so therefore we know our change in temporary differences was 30,000. So here the examiner has just made our lives easier and just given us the movement in temporary difference, the temporary differences, for each of the years, and therefore to find the movement we just need to simply find the differences between the two. Going into our additional information, TEC subsequently measures its intangible assets and PPE using the cost model. So here we're going to depreciate, here we're going to amortize. It's a policy of TEC to measure investments in subsidiaries, associates, and joint ventures using the cost model as per IAS 27.10 in its separate financial statement. It says with the exception of the change for the 2018 tax rate, income taxes are charged in accordance with the Income Tax Act and Charging Act. Going back to this, Honorable Thuli Noob announced the IMT tax of 2%. That is not an income tax. Therefore, that shouldn't affect our calculations and our question at all. The last thing is just all the shares of Takura were issued at incorporation. So that's just saying there's no changes as a result of any rights issues or any form of additional shares. So thank you so much and all the best with attempting this question.